All right. Good you guys came. I'm giving all the answers to the final today, so you'll be glad that you guys came. All right, so we're going to finish up chapter 25 today, talk primarily about consumption taxation. Music recommendations of one of my favorite live bands is called Ripe. They're a bunch of Berklee Music School grads. They're fantastic live, and they're playing the MGM Grand sometime this spring. I don't remember when, but good spring show to check out. Remember, if you need a break from final studying, Friday night, there's a fantastic concert at the Paradise, this band called Happy Fits. They're a super fun pop band, and you guys should check that out as well. Okay, so to remind you where we ended up last time, in which we talked about the various advantages of a more fundamental tax reform, both in terms of simplicity, reduced evasion, and increased efficiency. And we talked at the very end about the difficulties, the challenges of undertaking tax reform, both the political challenges and the economic challenges, given the transitional inequities through changing asset prices when you reform taxes. One example of the challenges you face in balancing these goals was actually seen in the Tax Reform Act of '86. Before '86, there were a huge number of tax shelters, these activities individuals did which were economically unproductive but were tax minimizing. The Tax Reform Act wanted to get rid of them. And the idea was to basically just get rid of tax shelters, but it turned out it was very hard to do so. It turned out it was really hard to get rid of tax shelters. So what Congress did instead was they said, we're going to go part way to getting rid of tax shelters. We're going to essentially change the tax code. So we're going to reclassify income as passive income and active income. Active income is what its name implies. It's your labor earnings. It's your dividend earnings. It's things from income generating activity. I'm sorry. Active income is things like your labor earnings or your returns to savings. Passive income is basically income in which you do not take an active role. So, for example, if you were invested in some apartment building and the apartment building, yielded some depreciation deduction, the apartment building you made rent off people living in the apartment building, but yields some depreciation deduction, you weren't taking an active role in generating that income. And what they did is they said, we are going to allow loss offsets only within the same category. So as if you buy an apartment building and you earn rent and use depreciation, you can offset the depreciation against the rent. But if that comes out to be negative, you can't offset that against your earned income. So we're not going to let you take losses on the passive side and offset gains on the active side. So it didn't get rid of tax shelters. It just kind of siloed them to sort of minimize the total loss to the government from these tax shelters. So it's sort of an interesting step. The problem was it made taxes incredibly difficult because we now had to decide what was active and passive income. As you can imagine, that's a whole new job for lawyers, is figuring out like what's active, what's passive, how do you classify them? So simplicity got worse, while more proper treatment of tax losses probably got better. So it's an example of the trade-off we face, that we all want simpler taxes, but it's not quite so easy. The easiest thing would have been get rid of tax shelters, but politically that was hard. They did something which made the system work better, but which added a new layer of complexity. Okay, so that's just sort of a last word on the difficulties of tax reform. Now let's come on to thinking about a fundamentally different approach to taxation, which is actually an approach most of the world takes much more seriously than the US, which is consumption taxation. Taxing consumption is an old idea. It goes all the way back to Thomas Hobbes, who in the 17th century treatise Leviathan wrote, "It is fair to tax people on what they extract from the economy as roughly measured by the consumption, than to tax them what they produce for the economy as roughly measured by their income." The idea is, why do we tax income? That's a productive activity. Let's tax consumption. That's what people are sort of extracting from the economy. That's what we should tax. And indeed, the US does have some consumption taxation, but it's relatively low. If you look at figure 25.5, about 17.6% of our tax revenues come from consumption taxation. That's compared to an OECD average of roughly twice that, of 33%. So other countries raise much more of their revenues from taxing consumption than we do. So the question is, should we move towards a consumption tax base, which has been proposed numerous times throughout history? So I want to argue, much we talked about with capital gains or estate tax, let's do the pros and cons of taxing consumption. So first thing is, what are the pros of shifting from so the idea is we're going to shift from an income tax to a consumption tax. What are the pros? Well, the first pro is improved capital allocation. Any income tax that's not a pure Haig-Simons tax is going to differentially tax different kinds of capital income. Capital gains, we differ from dividends, we differ from bank accounts. There's no income tax system in history has ever been neutral with respect to the different forms of capital income. What that means is any tax system based on income creates tax wedges that create inefficiencies. Because we want people to invest their money in the form which is the highest rate of return. We don't want people shifting their money around to try to game the tax system. Income taxes feature that. Consumption taxes don't. At the end of the day, if I just tax you on what you consume, then you have every incentive to invest your money in the most allocated, efficient way possible. There's no reason to favor capital gains over dividends. You just do whatever's the best way to earn your income, because at the end of the day, you only tax when you actually spend it. So all the inefficiencies, all the tax wedges you created between all the different ways you can allocate your capital all go away. We simply say, invest the money in the highest marginal product of capital activity, make as much as you can, then we'll tax you when you consume it. Okay? So that's one big advantage of consumption taxation. The second big advantage is it's less distortion to savings. That the income tax distorts savings while the consumption tax does not. So to see this, consider two individuals in table 25-2, Homer and Marge. Okay? They both earn $100 in the first period. Okay? In the top panel, we'll consider what happens to them under an income tax. Under an income tax, and let's say it's a 50% tax rate. Under an income tax, Homer and Marge each pay $50 in taxes. So left with $50 after tax. So I'm sorry, let me say this is a typical overlapping generations model. They only earn their money in the first period, but they live for 2 periods. So earn $100 in the first period, live for 2 periods. So in $100, they pay $50 in taxes. Homer takes the remaining $50 and eats it all. He doesn't consume anything in period 2 because he's Homer. Marge splits it equally. $25 and splits it. She consumes $25.61 in the first period. Having consumed that, her savings yields $2.44. Assume a 10% interest rate. So she's saving $24.44. Okay, that yields $2.44 in interest earnings. She has to then pay taxes on her interest earnings because it's an income tax. Okay, so she ends up consuming $25.61 in the second period as well. So she pays a PDV of tax of 51.11. She pays more taxes than Homer because she taxes on her income and taxes on her interest earnings, whereas Homer has no interest earnings. Now consider a world with a consumption tax. Okay, let's say to make things equal, assume 100% consumption tax rate. That is for every dollar you consume, you pay $1 in taxes. Well, what that means is in the first period, Homer consumes 50 and he pays 50 in taxes. Life hasn't changed for Homer. He consumes 50, he pays 50 in taxes. The PDV is taxed as 50. Homer is the same under income or consumption tax. But Marge, she gets to consume more in period 1 because the taxes aren't taken out yet. She pays taxes only on her consumption, not on her total income. Then the second period, she consumes another $26.19 and then pays taxes on that $26.19. So the PDV of her taxes is now $50, the same as Homer. What's happened? Well, since 2 things have happened. One is Marge gets to benefit from the inside buildup. She doesn't pay tax on her whole income, just on what she consumes. So she gets to benefit from the return to savings. The other is her interest income isn't taxed. The bottom line is she doesn't pay that extra tax. Remember, what's consumption? It's savings minus income. Okay? So basically, when you tax income, you tax both the earned income and the income on interest. That amounts to double taxation, which means savers end up paying more in taxes than consumers. Savers pay more in tax than consumers because of the double taxation of savings. You tax it when it's earned, and you tax it when you get interest on it. So Marge ends up paying more in taxes than Homer. This has two problems that proponents of consumption tax point out. The first is it's inefficient. There's essentially a tax wedge created by the fact that when you tax income, not savings minus income, consumption income minus savings. That's why you're all looking at me funny. You guys can correct me when I make a mistake. It's okay. I make lots of mistakes. Okay, don't just look at me funny. Correct me. Okay, consumption income minus savings. Okay, so basically, so the difference is that Marge pays extra taxes because she's taxed twice. Now, over one period, this doesn't matter much. It's a tiny difference. But over time, this becomes a big deal. So consider a consumer is $100 today and wants to consume 50, but wants to save the rest for 10 years, not 1 year, interest rate of 10%. Then that individual would end up under consumption tax with $130 versus under an income tax with only $80. Okay, so basically, if you, in other words, if you take this wedge between consumption income tax grows over time because of compounding, because the consumption tax lets you earn the inside buildup, and the savings tax doesn't. It taxes you every period on your interest. If you consider someone this same example of Marge and Homer and extend it to 50 years rather than 1 year. So let's say that Marge consumes half her income the first year and saves the rest for 50 years. She ends up with she ends up under consumption tax with 10 times as much money as under an income tax. She's 10 times better off under consumption tax than income tax, not just a little bit better off. Here she's, 5% better off. Over 50 years, she's 10 times better off. There's an exploding wedge because of compounding. So this is the classic argument why many economists would argue the optimal tax rate on capital is 0, that we should have a consumption tax. We should not tax savings at all. We should only tax consumption. Okay? That's the classic argument for why. There's also a horizontal equity argument, which is not only does this penalize savings, it's unfair to savers. Marge and Homer are the same. Just because Homer's a pig, he pays less taxes. That seems kind of unfair. It's also sort of a horizontal equity argument for why we should have a consumption tax. Okay? Yeah.
Like, what exactly would a consumption tax look like? Like, how do you know? How does the government know how much people are consuming?
Let's stay theoretical at this point. Imagine I can observe your consumption. We'll come back to that. But imagine I just observe your consumption. Okay? Okay. And then the third reason, other questions about this? The third pro is simplicity. Now, obviously, this comes to the last question, was just asked about how the consumption tax works in practice. But in theory, it's a lot simpler than people get income from all these different places. They just spend it. Whenever they spend money, you tax them. Think about a sales tax. Think about a national sales tax. That's the easiest parallel. Okay. National sales tax. They spend money, you collect the sales tax. It's really simple. What could be it's way less complicated. You don't need an IRS. Okay. Worrying about people's income from dividends. You just tax them when they buy shit. What could be simpler? Okay. So those are the big arguments for a consumption tax. Okay. The big arguments against a consumption tax, the big con arguments, the biggest one is vertical equity. So while there's a horizontal equity argument for a consumption tax, there is a strong vertical equity argument against a consumption tax because the rich save much more than the poor. Okay, so for example, those in the bottom fifth of their income distribution save 3% of their lifetime income, whereas those in the top fifth save 25% of their lifetime income, and those in the top 1% save half of their lifetime income. So the problem is, if you tax only consumption and not income, therefore excluding savings, you tax the rich much less than the poor. Now, there is a simple solution to this, which is eventually they're going to die. If you tax their bequest as consumption, this problem goes away. So it doesn't matter if the rich consume less than the poor, if at the end of the day you just tax it when they die. But the problem is we've seen the difficulties politically with the state taxation. We can't even manage to tax one of the top 0.06% of people. The state taxation, it's hard to imagine we'd have a full consumption tax on all bequests. So in principle, this is solvable by just taxing. If you treat a bequest as consumption and start to say consumption tax is problem solvable, but realistically, we're not going to do that. So what this means is essentially the rich end up taxed much less on a lifetime basis than do the poor. Okay. Now, in particular, you might say, well, that's an easily solvable problem. We could just have a progressive consumption tax. So instead of a sales tax, to come with the question has to do, imagine an expenditure tax. Where we track what you spend and then we progressively tax it. The problem is administratively, that's a nightmare. How do we possibly track what you spend? Okay, actually, two countries have tried this in history. I forget. I don't. Yeah, no. This. Yeah, I talk about it later. It's basically it basically hasn't worked. It's too hard to track consumption. You can tax a point of purchase, but then you can't make it progressive. Okay, so basically, consumption taxes by their structure are regressive. There's no way to have a progressive consumption tax, as it's been stated. Okay, now you could, in principle, try to get to progressive consumption tax by doing what many countries do and exempting the goods consumed by low-income people. Imagine a simple model where there's two types of goods. The type consumed, there's two types of goods. Everyone consumes type 1, and only rich consume type 2. That a consumption tax that excluded type 1 would only fall on the rich. So in principle, you could make a consumption tax progressive that way. What's the problem with that? Coming back to chapter 20. What's the problem with the consumption tax that's only on the goods consumed by the rich? What do you know about the, yeah?
They have higher or lower elasticity.
Higher elasticity. Ramsey would hate it. Ramsey would say, focus your commodity taxes on the low elasticity goods, not the high elasticity goods. It's super inefficient to tax only the high elasticity goods. So the problem with that, that'd be a super inefficient tax system. Yeah.
Can you talk about something in 1401 where it's like the more an item costs, the more people like want it? I don't know if it's like a
Yeah, that's yeah. There is an old model called the bandwagon effect model due to Thorsten Veblen, which is this idea that in some sense demand curves actually slope up, and that once things get expensive, it creates demand for them because like this bandwagon effect. That's not true.
Okay.
I mean, you can imagine small case it might matter, but it's not really true.
Okay.
So that's basically, so it's pretty much impossible to effectively address the vertical equity argument with the consumption tax. That's the main argument. Now there's a couple of other arguments against the consumption tax. The first is that is basically, it's sort of a form of the vertical equity concern, which is targeting savers. What do I mean by this? Well, remember, when we think about the optimal income tax, the big thing we want to do is we want to tax the rich more than the poor. But if the only signal of rich and poor, think about income tax in the framework used in chapter 17 for welfare. We said the problem with welfare programs, we want to take from the rich, distribute to the poor, but the poor then will stop working. Okay, so we'd like a target, a way to identify someone who's poor. Okay, well, it's a similar argument with taxes. If I knew for sure who was really able to pay taxes, I could tax them more and redistribute more effectively. Well, in some sense, savings is a signal. Since the rich save, by taxing savings, we're really finding the people who are truly capable of having the high ability people and taxing them more. So that's sort of another version of this argument. A third point, which is more important, is the point about transition issues. Which is which is unfortunately, there is a status quo bias. The fact we have an income tax today means that to move to a consumption tax, you would have to ask who wins and who loses. So let's think about a simple model with three types of people: the very young, the people sort of in the, roughly through the middle of their lives, and people who are retired. Who wins and who loses when you move from an income tax to a consumption tax? Well, the young, the not yet born especially, they win. Why do they win? Because moving from an income to consumption tax raises the capital stock through more savings, as long as substitution effects dominate. Raise the capital stock through more savings, higher capital stock means a more productive economy means higher wages. So future generations presumably win. Current generations are sort of indifferent. It sort of depends, they're going to pay less income tax, more consumption tax, depends how quickly the capital stock adjusts, it's not clear. But the old are clearly screwed. Okay, let's do a simple example. Imagine that people earn $200 in the first period. People earn $200 in period one. Okay, they consume 100 in period one and 100 in period two. They consume 100 in period one, then they save the other 100, and at a 10% interest rate, they get 110 in period two. Okay. Now, with an income tax of 50%, so this is what they do with no taxes. Income tax of 50%, let's say that they would end up with $100 the first period. Let's say they would save half. So then they would, let's say they'd save half. So they would save 50, and then at $55 they'd consume 45 in the first period, something like that, 45, 55. The math isn't quite right, but you can work it out. Okay, so they basically would pay $100 in tax in the first period, and they'd pay. Actually, let's forget these. Let's imagine just forget the dynamics of how that adjust. Ignore their adjustment. They're paying $100 in tax in the first period, and they have to pay another $5, let's say 50% tax rate. They have to pay another $5 in taxes in the second period on their interest earnings. Okay, so they pay $100 the first period. They pay 50% tax on the 200. They pay $100 in taxes. So the tax bill is 100 in the first period and 5 in the second period. Okay. Now imagine we say, sorry, old people, right after you're retired, we switch from an income tax to a consumption tax. What's their tax bill now? Well, they still paid 100 in the first period, and now they have to pay $55 in tax in the second period. If there's a 50% consumption tax. So they get taxed twice. They get nailed coming in and nailed coming out. Their taxes go way the heck up. Yeah.
Could you let them have the income tax?
So this is a transition. You could say, fine, we won't tax people over a certain age. But the problem is then you lose, you could let them keep the income tax. You could do that. But basically, the problem is a lot of the benefit of a consumption tax turns to come out from taking all this money from old people. And if you model people's models of consumption tax and how good it is for the economy, if you don't impose on the elderly, it's much less beneficial. Because a lot of the money you get from the consumption tax is basically stealing the elderly savings. That's a big benefit of the consumption tax. You basically get to impose what's called a capital levy on the elderly. And a lot of that goes away. In the very long run, you could get away with that. But the problem is then who gets to keep the income tax? Do you let people choose? Well, then that's really messy. Do you do some age cutoff? Or how do you choose the age cutoff? So it's sort of messy to do it. So there's a lot of messy transition. You can't just choose 65 because people at 64 are sort of screwed too.
I was thinking more like just let that cohort of people keep the income tax, and then everybody before them who does the consumption tax for most of their life. It's like
right, but they have to find most of their life. I guess you could start saying only people who are 21 or younger pay the consumption tax going forward. The problem with that is that then you're going to have a short-run deficit in your government budget, because while they were paying income tax, but they don't consume as much. So you have a short-run deficit you're going to have to make up on the back end. So there'll be some financing issues. So the transition is messy. Okay, that's the second problem. This transition problem shouldn't matter, but they do. A fourth problem is compliance. People say a consumption tax is simpler, but it's a different world with a 5% consumption tax and a 30% consumption tax. With 30% consumption sales tax, people can buy a lot of stuff out of the back of vans. Okay, there's gonna be a lot of it. It's gonna be a huge black market when everything's 30% cheaper when it doesn't run through the formal sector. So compliance could be a difficult issue here as well. And then finally, we have a new problem, the problem of cascading. The problem of cascading. The cascading problem arises because for many production goods, their inputs can be classified as consumption goods. Consider someone who delivers baskets of fruit. Well, they have to buy the fruit to put in the basket. What that means is switching consumption tax means that adds an extra tax on their inputs. So companies that use inputs that are consumption goods now have an extra layer of tax they have to pay. And that's another problem with consumption taxation. Okay. Now, the bottom line is the real debate over, yeah.
Like European countries.
I'll get there. So the bottom line is the real debate over consumption tax is really distortion of savings versus vertical equity. The rest of this stuff is interesting and fun for a class like this, but the real meat of the argument is conservatives and economists like consumption taxation because it's more efficient, presuming substitution effects dominate income effects, and liberals don't like it because it's unfair. There's a great saying, which is once liberals realize consumption taxes can raise a lot more money to spend on good things, and conservatives realize consumption taxes are hard on the rich, they'll switch positions. But you're never going to get both sides to agree on this. And so essentially, there's really a real challenge. In fact, a number of conservatives actually don't like consumption taxation because the theory is that it'll make taxes. There's basically a sort of interesting political economy argument against simple taxes, which is the simpler you make taxes, the more the country will raise taxes. I talk about Amy Finkelstein's Easy Pass paper, that basically the less salient you make taxes, the simpler you make them, the more people end up, the more governments will have to end up raising taxes, which conservatives don't like. So it's a very complicated and difficult debate. Now, in practice, the questions about that. Now, in practice, what most European countries do, as our European student points out, is impose what's called the value-added tax. The value-added tax is a consumption tax designed to deal exactly with the fifth and fourth problems here. How does a value-added tax work? Basically, table 25.3 shows how it works. Imagine that you have a table that you're going to sell for $100. And let's say there's a 20% consumption tax. Well, if it's just a sales tax, then basically the way to work is you'd sell for $100. The guy who sold the table will pay $20. And that'd have two problems. First of all, there'd be a huge incentive to cheat. And second of all, the inputs would get taxed along the way. So there'd be some exploding tax burden depending on the levels of layers of things that made up that table. What a value-added tax does instead is tax you only on the incremental value added each stage of production. So for example, this production of the table starts with a logger. That logger doesn't buy anything. He just goes out and cuts down trees. He then sells the lumber for $25. So therefore, his value added is $25. He pays a 20% tax on that at $5. Then it goes to the manufacturer. The manufacturer pays $25 for that wood. She then takes that wood and makes tables that she sells to the retailer for $75. So her value added is $50. And the way it works is she goes to the government and says, here's the receipt for what I paid for the wood. Here's the receipt for what I sold the wood for. The difference is $50. That's my value added. So she pays a $10 tax. It then goes to the retailer. The retailer pays $75 for that table. She sells it for $100. So her value added is $25. And once she goes to the government and says, here's a receipt for the $75 I paid for the table. Here's a receipt for the $100 I sold the table for. The difference is $25, so I owe $5 of value added tax. Add it up, and you get the same $20, but without the cascading. No one's paying taxes on the inputs they buy. Plus, with better compliance. Why? Why is compliance much better with value-added tax than just an end of the process sales tax? What's the difference here? Why is it in some sense self-enforcing? Yeah.
Because one guy is saying, I sold it for this much, and the other person's like, I bought it from them for this much.
Exactly.
There's no.
If anybody cheats and tries to say they sold it for less, the other person say, wait a second, no, that hurts me. So basically it's self-enforcing because any cheating by one stage hurts the people at the next stage. So compliance gets better because there's a self-enforcement along the way. Yeah.
Like this subsidiaries of one company, like one produce some intermediate goods, like they also take out that when they export them to the mother company.
Exports and imports are tricky with a value-added tax. The way exports and imports work in value-added tax is you get to deduct the value-added tax from the exports. I'm sorry, you have to. I don't remember. It's really tricky. Border adjustments of value-added tax are very messy. Okay. Other questions about that? Yeah.
How is this different from like what we talked about with Texas?
Well, no, this is not. This is. Go further. I don't quite understand your question.
Like the manufacturer buys.
No. But that is not a profit because along the way she hired workers and things like that.
So it just
That-
has to be-
It's a revenue, not a profit. It's a tax on, or in other words, the point is that it's a tax on the difference between sell for minus what you paid. If literally the production process was just her painting, then still wouldn't be a profits tax because her effort goes into it, right? It's you deduct one input, but not all the inputs that go into your production. So it's not a profits tax. Good question. No questions. Okay, so that's how value-added tax works. And that's the way consumption tax work in Europe, but it doesn't really resolve the fundamental debate, which is basically the equity and versus efficiency debate. Now, if you look at the equation that consumption equals income minus savings, this suggests that there's another way to get to consumption taxation, which is not at all that complicated, which is simply allow everyone to deduct their savings. If you say I'm going to have an income tax system where savings are fully deductible, then you have a consumption tax system, right? This is called what's called cash flow taxation. In that sense, the US partially has a consumption tax system. It's not measured in that table I showed you, but we have some consumption tax because we allow people to have tax preferred retirement savings. But it's only a partial consumption tax because we still tax those savings eventually, and other forms of savings are taxed. So basically, unless you have a capital gain that you leave to your kids, savings is ultimately taxed to some extent. So we don't have a full cash flow system. We don't fully tax consumption, but you can back into that. The advantage of that is you could then imagine trying to make it a little more progressive. You can imagine trying to add some progressivity, but it's still never going to be progressive enough because the rich are always going to save more than the poor. So the rich are always going to pay less in taxes. What I like about thinking of cash flow is it really highlights the regressivity, which is basically the rich do all of this. So if you're just saying it, a consumption tax, income tax minus deducting savings, you're saying it's an income tax minus the deduction for the rich. Okay, so it's really sort of highlights how regressive a consumption tax is. Okay. So any questions about consumption taxation? So now let's come to sort of the bottom line on sort of tax reform. The bottom line on tax reform is that we worship at the altar of Haig-Simons, that basically the best tax system is a comprehensive tax system for many reasons. In many ways, it'll be simpler, although not always. It would be tougher to cheat because all income would be taxed. There wouldn't be a place you could park your income that wouldn't be taxed. And because you'd have a lower rate. And it'd be more efficient because you could have a lower rate on a broader base. And that's more efficient for two reasons. One reason is the standard toss squared reason. The other reason is that progressive taxes are particularly inefficient because the rich have higher elasticities than the poor. So this says that there's a strong argument, a strong presumption towards a broad-based, relatively flat tax. Now, most economists would go further. They'd say, furthermore, we should exempt savings. They'd say, furthermore, we should exempt savings, but that has an extra big progressivity cost. So I think almost all economists would favor the broadest, a very broad base of taxation. So if I think about where economists rank in terms of consensus, I say there's a very strong consensus for a very broad base of taxation, certainly broader than we have today. I would say there is a mixed consensus how progressive taxes should be. Okay, there's many people now who are arguing, there's sort of a new rebirth of people arguing we should have a very progressive tax system. People like Size and Zuckman out of Berkeley who are saying income inequality is so bad, we need progressive taxes to offset sort of dynasties, wealth dynasties. But I think most economists would argue that sort of a broader, flatter tax system kind of makes sense. I think where you have the most controversy is should we take the next step and make it a tax just on consumption? And there, I think economists Probably the modal economists would say yes, but there you get closer to 50-50 split because of progressivity concerns. And that's sort of where we end up on tax reform. All right. That's all I want to say about chapter 25. Any questions about tax reform at all? Or consumption tax or any of the stuff I covered last time too? Okay, then let me spend a few minutes talking about the final and sort of wrapping things up. Final is going to be like the midterm, some long problems and some short answer problems. Like the midterm, you only get as many points as the minutes listed there. So do not misallocate your time. Okay, there will be long problems throughout the exam. So don't end up facing a 40-point problem with like 5 minutes left because you spent 20 minutes writing a beautiful essay on a 5-point question. Okay, make sure that you allocate your time appropriately. There's a lot of math. There's going to be hard math, just like in this class, but you can get a lot of partial credit with good intuition. If you're going down a math rabbit hole and you just feel stuck, it's okay to stop and say, look, I know this is where the math is heading because this is where this is what I know from class. I know this is going to be the conclusion we're heading to. I'm going to explain it, explain the intuition. You get a lot of credit for that. So if you get stuck on the math, don't keep banging your head against the wall. Go ahead and provide the intuition. Okay. Yeah, and it's going to cover the whole semester's game. It's going to be more heavily weighted towards post-midterm, maybe 2/3, 1/3, but there'll be a lot of pre-midterm stuff on there as well. The whole semester's game. I think my main piece of advice for you for taking the exam is when you see these problems that always look scary when you first see them, take a deep breath and think about what section of the course we're asking about. What's the topic? What are the key things you can remember about that topic? And then dive in with that perspective. Any questions about the final? I think we've arranged for everyone who needs special arrangements. I think that's all set up. Okay, well, in that case, let me just sort of wrap up the class. I think, and those of you who had 1401 with me, I make a similar speech, so apologies for the redundancy, but basically, the point of this class, I'm really glad you guys taking this elective. I hope you'll take many more economics electives and study much more economics. I should say I'm always happy to talk with anyone about what economics classes they are interested or should take, or grad school or whatever. I'm happy to talk more about that. But I really hope that what this class leaves you with is just a really useful framework for thinking about how to think about economic policy. I don't need you to remember for sure exactly, only Medicare and Medicaid, that's all I care about. Anything else you can forget. But I want you to remember how to think about economic policy, how to think about, gee, a tax break may not make sense because a lot of money's in for marginals, just goes people who had it already, or, gee, there's a trade-off. This program sounds great about giving money to the poor, but there's a trade-off, and here's how I want to think about it. Basically, just to be a more intelligent consumer of the policy debate and to help your friends and family more intelligent consumers. Okay, we could all use a little more intelligent political debate in this country. You are the next generation of leaders of this country, so you can take a leadership role in making sure that the debates we have, regardless of your political opinion, are more informed and more intelligent and more nuanced of the kind we talked about this semester. And then I always like to end with my favorite economics joke. Apologies, you've heard this one before. How many have heard my golfing joke before? Okay, not too many, good. Okay, so the priest, the doctor, and the economist go golfing, and they get on the course, and they're behind one guy golfing alone, which is already kind of unusual. And the guy's going incredibly slowly, like 25 shots a hole. It's painful. Now, normally, the golfers among you, I'm not a golfer, but the golfers among you, well, you know that if you're going slowly, you're supposed to let the people behind you play through, kind of ahead of you, so you don't hold them up. But this guy wouldn't do it. And so there were like dozens of people piled up behind this guy. It was crazy. So this group of 3 doctor, priests, and economists were like, God damn it. Well, the priests didn't say God damn it, but they were like, damn it, this is ridiculous. They quit the course. They go to the clubhouse. They're drinking. They're really upset. And someone comes up to them and says, excuse me, are you new to this club? And they said, yeah, it's the first time I've played here. Said, well, I could tell you're new because if you weren't new, you'd know that the guy you played behind is blind. And actually, it's sort of considered a miracle that he can get the ball in the hole at all. And people are usually honored to be on the same course with him. And the guy walks away, and it's sort of a stunned silence, and they feel pretty terrible. And the doctor says, like, wow, I can't believe I said such terrible things about someone who had a medical disability. Me of all people shouldn't be saying that. I'm going to dedicate a free wing of my hospital to the blind. And the priest says, I mean, you feel bad. What about me? I'm a man of the cloth. I'm supposed to love all my fellow man. Here I'm saying these terrible things about this guy. I'm going to have a free soup kitchen for the blind. And the economist goes, well, if he's blind, why does he golf at night? And that is I love that joke because it shows that the ultimate role of economists is to sort of be a pain in the ass and to sort of ask the uncomfortable questions and the thoughtful questions that we don't ask. And we'll maybe never have the Kosian perfection where we pay people next to us on the plane to be quiet. But we can move to a world where we think about things a little more rationally and ask the tough questions, and as a result, get sort of better outcomes for policy specifically. So with that, I'm going to stop. I'm going to ask you to take, those who haven't yet, I'm going to ask you before you leave, take just a couple minutes to fill out your course evaluations. If you have already, great. You should all have the email. If you haven't, please take a few minutes to fill out your course evaluations now so we can get that done. Thank you all for an excellent semester. I really appreciate it, and best of luck on the final.